So yeah, my name is Marina Draper, and I'm the owner, founder of Real Estate Accounting Pro. We also go by Draper Tax. So what we do is we do accounting and taxes primarily for real estate investors. So for people who buy real estate, renovate real estate, develop, build, rents, all kinds of real estate. We work with property managers, we work with real estate agencies, and all kinds of real estate related businesses. And so for today, yeah, I was invited by Todd. Thank you very much for inviting me. It's my first networking event since 2019, so very exciting. It's like nice to be around people. It's awesome. I miss that. But yeah, so for today we'll just talk briefly about tax strategies. So we have around maybe 7-8 weeks left until the new year, and now is the best time to do tax planning because we accountants have time to do it, and because you guys still have time to take action right now. Like starting January 1st, the bell rings, the ball goes down, and that's it. There's, your options are much limited starting January 1st. So right now is the time to think about it. So we'll go very briefly because, taxes, I can talk for hours about tax. I can talk all day about taxes, all night, but I know you can't, so I'll make it brief.
You'd be surprised, I think. Guess we'll find out.
Really, let's find out. Yeah, absolutely. So just a quick overview of what you can do before January 1st. To save you money, because a lot of real estate investors, beginner real estate investors, what they don't realize is it's all about return on investments, right? And they don't factor the tax into that. A lot of them, not everyone, but a lot of them don't factor the tax side. When you have your return on investment before tax, and you have tax and you have your net return, and that piece can be 30-40% of your full return. So it's a huge piece that you can change with the help of a tax expert and with knowing what to do. So what are some things you can do? What we do for our clients. Right now I get a lot of calls and a lot of these things are happening. Like today I had some, tomorrow I'll have some more. So what we do for our clients, just a brief overview. So number one is the legal structure of your business, and that's not like for tax planning, it's not as much for rental owners as for flippers, developers, real estate agencies, brokers, contractors, so people who own active businesses. So for passive rental, it's still good, it's still important, but not as much as for active businesses. So what you can do is, change your legal structure. It will give you some tax advantages as well as the legal protection. Because many real estate investors, they start out with just buying properties in their personal name. They don't set up LLCs, they don't set up trusts, and then things happen or not. It can backfire on you if you don't think about it in advance. And for active business owners, like as I said, flippers, real estate agents, wholesalers, developers, for them, it can also cost them a lot of money if they don't think of it up front because they are taxed very heavily. So talk to your legal advisor, talk to your tax advisor. There are different strategies. There are LLCs, there are S corporations, there are C corporations, there are trusts, there are all kinds of things that we don't have time to cover right now. Advantages of disadvantages of all of them. But we use all of them, we mix them sometimes, or we just use one thing and then we add another thing, so it's very creative, it's like a whole process. But definitely think about that. If you don't have an LLC, or if you're an active business and you don't have a corporation yet, talk to your advisors. The second thing is what you can do is max out your retirement plan contributions, right? Your 401ks, your IRAs. If you have like W-2 jobs, you can do 401k contributions up to $19,500 this year. So think about that and plan for that. For IRAs, you still have time until April 15th to do the IRA contribution. So you still have time, but still think about it, plan for it. Another thing is a Roth IRA conversion. So that's not like a tax saving tip like today. Roth IRA conversion is actually what makes you pay tax. So when you have a traditional IRA account, you can convert it into a Roth IRA, which makes it tax like after tax. So which makes all the earnings in your IRA tax free. When you withdraw them, you'll not pay any tax on it. So think about that. You know, if this year has been like a slow year, if your income maybe was lower than the previous and lower than the future years, especially we know that in 2026 the taxes will go up. And also Biden is talking about even more taxes, so we don't know how that will play out. We know that the taxes will go up, so Roth IRA conversion is something you can do to help you with your taxes going forward in the future, starting 2026 when we know that the tax will go up. So something to think about this year or next year. Again, talk to your advisors, plan for it, because it's not just like, oh, I'll go and do this thing, you need to know what will be the effect of that, how much you want to convert this year versus next year. It's like a whole plan that we do, different scenarios that we run for our clients. Another thing is a very popular strategy is sell loser investments. So if you have like stock and you sold some of them, like stock or cryptocurrency at a loss, and then if you have other stock that you sold at the profit or cryptocurrency that you sold at the profit, you can offset one towards the other. So you can offset those losses from the stock that generated losses against the profits from other stock that generated profits. Because normally you can only deduct up to $3,000 a year of those losses, capital losses. But if you have some capital gains that you have this year to plan for, maybe you sold the property and you have capital gains from there, you can sell that loser stock or that loser whatever investment you're holding and offset those capital gains with that loss. Another thing that we do sometimes, but that's more like a big strategy, big steps, so definitely talk to a tax advisor, is if you know that you have big capital gains this year or some big source of income that you want to offset, one thing we do is that if our client buys a rental property this year, they can do a cost segregation study, but again, that's like a very complicated process and definitely something to talk about with your tax advisor, because it's not for everyone, like big consequences and it costs a lot too. But if it works out, if you do it right, in that case, for example, if you sell your property, or you sold a lot of stock, or you did like a flip and you have a lot of profit that you want to offset, in that case, you can buy a rental property, do a cost segregation study, run it together with bonus depreciation. Again, something we're not going to talk about like in details today. That can take until tomorrow morning. But you can offset huge, like hundreds of thousands of dollars of that income if you do it right. But again, that's like a big process, but it needs to be done before the end of the year. So again, if you know that, I'm selling this stock, I'm selling a lot of cryptocurrency, or I got this flip, I sold it, I'm planning for a lot of money, what do I do? Some things you can do is, buy a rental property, run a cost segregation with bonus depreciation, write it all off, and sleep. Okay, so other things is charitable contributions. I mean, that's more like, you do it or you don't do it, right? It's more like, not as much as a tax strategy, but if you itemize your deductions this year, then you can make a charitable contribution, and increase that deduction, and deduct. Again, something to do, like sometimes we work with our clients is we lump it up. So we create a charitable fund. For example, if our client is like into charity a lot, like they want to constantly donate, give back, in that case, we help them deduct that as well, because there are certain limits on how much you can deduct. But if you set up like a charitable fund, and in 1 year you donate like a lump sum, then you can deduct all of that. Versus if you just donate like a little bit each year, that way you might not be able to deduct that as part of your itemized deductions. That might not make sense for you. So Some things we do, yeah, as well. And even if you have like standard deduction, they still allow $300 to deduct for everyone, for single, and $600 for married filing joint filers. So at least you could get that. Start with that, but if you're planning to donate, you can just create a fund, lump it all, create like a big deduction. And the last is catch up on your bookkeeping and make it, flawless, and make sure that it's all perfect, again, before January 1st, because that's the number one thing that my clients are missing is like the bookkeeping part. They think, okay, taxes, I need to save on taxes, but bookkeeping is the foundation of every tax return. Like if you don't have bookkeeping right, like your tax return doesn't make any sense, and all of my work will be just useless. So doing bookkeeping is important. Yourself, get like the QuickBooks or do it yourself or hire a bookkeeper. We do accounting for our clients as well, and make sure that they don't lose on those deductions, because oftentimes they just like forget to deduct things. Or they just, like March 15th, they will be like, I need to file taxes, like what do I do? So they just pile something up real quick, and of course they'll forget something, of course they will miss out, and there's money on the table. So absolutely, I recommend doing bookkeeping. And it's boring, it's sad, it's aggravating, but it's very, very, very important. It'll save you a lot of money, so it'll be worth it your time. So that's it for today. I mean, we do a lot of different other things that I did not include, maximizing your tax deduction, and a lot of missing out deductions that our clients are just, before working with us, they just were not aware that they can do it. And that's all work, with your tax preparer, with your tax professional. If you don't have one, you can reach out to me, and make sure that you maximize your deductions, your home offices, your mileage, your education expenses, all the books, these meetings, pretty much every dollar, that you save will save you, 30 cents in taxes. So 30% return on investment is the best investment ever. So
not too bad.
yeah, invest in that. Yeah, so that was all for today. But yeah, I'm ready for all the questions if you have any.
Yeah, let's definitely take some questions. I can personally attest to your real estate expertise, because I was looking for a CPA, for a real estate CPA or tax professional, for almost 2 years before I found you. I was introduced to you, and I've been very impressed. So, and I know we get a lot of questions, agents and investors, we get a lot of questions about tax things as well. Should I buy it in an LLC? What's a cost segregation study? We actually had a presentation both in Worcester and in Lowell, and we will in the next couple months here specifically on cost seg, which, as you know, can take up a whole hour by itself. So
exactly.
Let's fire away. What questions do we have? We'll start in the back.
You said bookkeeping is the most important thing. I guess that makes sense, right? So if say a real estate agent, aspiring investor, or the active investor, agent was to come to you and try to get some tax information, like how could you wrap it up in a perfect little gift just to hand over to you and make your life easy? Like what does that look like in terms of tech apps to do it? Mm-hmm. Like how should I come to you on our first meeting, or like say the end of the year for tax purposes?
Yeah, so for our clients, we're pretty flexible. We're trying to work with them. Normally, if our clients are not doing bookkeeping with us, we ask them to provide us with basic financial reports. If they cannot, if they don't have any financial software or bookkeeper, then we just send them a worksheet that they fill out, just this is what my income was, and different deductions so they don't miss anything. My mortgage expense, my taxes, my utilities, my repairs, my capital investments, my mileage, my home office, my internet, my phone, my all kinds of all these different deductions, and then they just fill it out. But of course we prefer our clients to have accounting software, and hire a bookkeeper would be ideal. It doesn't usually work for if you have 1-2 properties, then you can probably do it yourself and manage. at least to start with, we recommend having, like, setting up separate bank accounts for each property. So that's my number one recommendation, like someone who, like, just bought a house or just buying a house and just has one property, let's say, just to set up a separate checking account with a debit card that they can just, only use that account for that property. That way, at the end of the year, all they have to do is export this, like Excel from their bank account and just, sort it by the vendor and just create, figure out how much money they spent on their business.
And I guess part two, or my question would be, so right now I own no properties. I'm an active real estate agent and acquisition manager for an investment company. So if I were to create it, say, a separate business-only credit card, and I print out that statement and have a business-only checking and savings account, and just hand that over to a CPA, is that what you guys are looking for? Are you looking for kind of to go a step further, or?
Yeah.
Okay, so that would work.
I mean, that would work,
Okay.